Have you ever taken a clean day trade? It starts working and then gets completely wiped out. You didn't get the entry wrong. It's not your strategy. You ignored the higher time frame. That's the mistake most day traders make, and it's why great looking setups fail. So in this video, I'll show you the exact top-down process I use to align timeframes properly, avoid mistakes, and turn random trades into structured, high-probability opportunities. So here, we're looking at a chart. This is a 5-minute chart. On this chart, we can see pretty much a fat load of nothing. This market isn't really telling us anything. And if we were trying to trade this from a low time frame day trading perspective, we're going to have a lot of difficulty finding a position, because realistically, the market isn't doing or telling us anything. So instead of just looking at this in confusion and gambling a few trades, as people do, what we can do instead is jump up to the higher time frames and analyze from the top down. And for day trading opportunities, where you're trading anything from the 5 to the 15-minute time frame, I still recommend that you start on the daily. So if we go to the daily time frame here on EURUSD, we immediately get a better idea of what is going on. So the market right now, from this daily perspective, is somewhat downtrending. This downtrend has pushed past this low here, and this low here also formed equal lows. We've got 1, 2, 3 equal lows, which creates liquidity. Now beneath that, we have an imbalance. An imbalance is an open price range. This entire candle would be classified as an imbalance, but the market did come quite the way through it without quite filling it. So realistically, the imbalance that we have here is the area between the line we've just drawn and this demand zone. So that is our imbalance. Now immediately, we've picked up on a few different pointers that we wouldn't have seen from a lower time frame perspective alone. We have liquidity, 1, 2, 3 equal lows being swept, and we have a demand zone through an imbalance, and the imbalance is not filled. The demand zone, which is this last candle before the impulse, has now been retested. So now that we've had the sweep of liquidity, now that we've traded into this demand, what does that tell us? Well, that tells us that there could be opportunity here for us to take the market higher. So even though that lower time frame, 5 to 15-minute market, is just a complete mess, we've got an idea immediately just from looking at the daily. If we've seen sweep of liquidity, fill of imbalance, retest of demand, that could lead us into a bounce in this market. Now, if we also discuss this trending structure, although this phase that we just discussed is indeed bearish, the larger phase of price action here, being from this low onwards, is actually pretty bullish. We have continual higher highs and higher lows, and we've now identified that this bearish trend has actually just been a pullback inside of the large upward move. How do we know that? Because the break that's taking place here is not a clean break. It's not a break of significant structure. It's actually leading out to look like a sweep of liquidity and a fill of imbalance. With that said, we could then anticipate a continuation of further upside. Now we are day trading. I haven't forgotten that, which means we're not really going to be looking to take this trade all the way through to a considerably higher level. We are instead focused on shorter term moves, which means we want to take a trade that's going to be a few hours long, with the opportunity to potentially stretch out into something larger if the opportunity arises. So we don't need to stay up here on the daily, but we've got a really nice idea as to what could happen now. If we then follow the top-down process by going down to the 4-hour time frame, we will get a clearer indication as to where we could start to target for positions. So taking a look at this market from a 4-hour perspective, we see 2 equal lows just there, swept. And we can see that the market is now rejecting that lower pricing, which is indicated by this wick that we're seeing coming up here. Now, this doesn't confirm anything yet, but it is a good indication that we could be going through with that reversal that we just discussed. But one of the biggest things the 4-hour will allow us to do is refine our targets. So if we had the idea that the daily might potentially be turning bullish, well now, we can look for refined target opportunities. The first target we have in mind would be this supply zone just here. This is the supply. It's a very messy one, But basically, because of the imbalance that we've got running up here, that open price range, we'd anticipate that generally the market will at least make its movements up towards this point. So there's a nice solid target for us. But above that, we can see we have this swing high that could also be another potential target, and a huge open imbalance into this area here. So the imbalance once again is this open price range. And now we're provided with a few supply zones. So to mark supply, I used the last candle before the impulse, just here. This is the last candle before the impulse down. And we would do the same here, but it's a bit of a mess. So I'm actually going to draw it from the top of the wick down. We are ideally using this last candle before the impulse, but we should also account for that choppy news-driven movement. So just by looking at the daily and the 4-hour, that little range that we saw is no longer a complete mess. Instead, we have a pretty solid idea that the market could bounce from here, and we have some pretty solid targets that we can use for number 1, day trading, and number 2, extending some of these day trades out into interweek positions. So trades that we hold for a few days, instead of just a few hours or minutes, these interweek positions, and being able to turn your day trades into interweek positions, is where a lot of the profit potential is maximized in your trading. I've entered positions before where I've entered with the plan of taking a 1 to 4 risk reward, and then ended up holding for a 1 to 30 risk reward plus. Now, by no means are these common. This is a once every year or once every 2 year scenario, but these things can happen, and this is where they are born, from doing top-down analysis. So now we can go down to the hourly time frame if we want to, and what we can do here is just refine some of these areas. The imbalance that we just drew now leads us up towards this point, so we can remove this as a target and extend that target even further into this point here. If we were to get the sweep, and yes, I know on the 4-hour we saw it did push down lower, we would then be looking for continuation opportunities towards this point. This would be our day trading format, and then we could potentially extend it even further into interweek positions to tackle some of those larger areas we discussed. So now let's go down to that day trading time frame. I'm going to focus on the 15-minute. This is a good day trading time frame. You can go to the 5, you can go to the 1, but your results will be cleaner on the 15-minute, because that is where the opportunities are going to be safer and more accurate. The higher the time frame, the more accurate the signals the market gives us. So we've turned an absolute mess that we looked at initially on these lower time frames into a fully fledged, fully viable trading opportunity. We identified these equal lows. We identified the possibility of a bounce from this demand. We identified some targets, and now we can actually start to day trade this. So after Asia's session, we saw the market move down. We've seen that sweep of liquidity under here, and now we can use these lower time frames to actually day trade our way into larger opportunities. So here we have seen the market sweep this low. We've seen many bullish rejections coming in. Bullish rejections indicated by this collection of wicks. Wicks show rejected prices. So what we're seeing here is equal lows being swept. And then we're seeing the market pushing back up. We're seeing a big influx of buying taking place here because the market's failing to close anything lower than this level, really. So because of this, we know buyers are coming into the market. On the 15-minute here, we've also seen the shift in structure. This is some internal structure on this larger movement. But for day trading opportunities, we can work with this internal structure. So what we've now seen is a sweep of liquidity, bullish momentum coming in, and shift in internal structure. That is over this point at the highest, and then also some of these smaller points as well. And what we can do at this point is just follow out our usual plan. So for me, that's going to be looking for demand zones to buy from. I like to buy from demand and sell from supply. I don't really get into the markets in any other way. So for me, sweep of liquidity, shift in the internal structure, this would be the demand zone that we could look to buy from. So what we have now is no longer just a choppy mess, but also the opportunity to turn this into a significant trade. Now, another thing is with day trading. Let's say we wanted to target this high for a sweep, because this is the only target we could identify on these lower time frames. Our risk reward is not going to be so good. the risk reward on this position would be 2.1. That's not great for me. I want to be taking more than a 2.1 on the trades I take. Generally, I want to take a 2.5 or 3 or more. So this would be a tricky one for me to push myself to get into. In fact, it would go against my plan, so I wouldn't get into it. But because we've got that higher time frame narrative, we now understand the market could actually come all the way up to this point, which obviously is going to dramatically improve the trade. So we now have a 9.4% potential trade on the cards. We could potentially get into this and run it all the way up to this larger target. Now this is where day trading can intertwine with the higher time frame trading or the interweek trading. There is no reason realistically, unless you're trading futures, to get out of the trade before it ends. If you have a clear target defined and the market is moving towards that target, you can hold trades longer. You can still use your day trading methodology to get into the positions as we've done here, but you have the opportunity to hold the trades out for your larger targets. So now let's see how this trade goes. As you can see, we come down, we get a tap in, we then have a push away. Now there's also secondary opportunity formed here if you're a bit more conservative, where we have the true break of structure. The market comes up, pulls down, trades into this demand, and then we get the push away. We can put stops under the low, same target, that's all good. So let's just jump it back to the initial, just to keep it running through. Now we can see the market is pushing towards these highs, and where this could be the target done for your day trade, this would actually allow you to extend the profits further later into the day. So let's take a look where the market gets to by the end of the day. The end of the day for me is going to be classified as around 5 p.m. UK time, which is just where we are coming into here. So at 5 p.m. UK time, that's the end of the New York session. The lower volume timing starts here. If you wanted to take your trades and all the profits on your trades, then this would be where you'd be taking your profits, which means instead of just taking the 2 risk reward position, you could actually extend around a 4% position out of this market just by using those market timings and that top-down analysis process that we've run through so far. But this is where the real beauty of this top-down analysis process comes in. Now, obviously, first of all, the real beauty came in from the fact we turned this messy, unintelligible range into something we could actually trade. But past that, it's the profit maximization that is so valuable. Because we know the market is likely to lead up towards these higher areas on the higher time frames, we can use this intraday entry to extend our profits dramatically. So let's say we wanted to be true to the day trading fashion and get out of half of our trade at this level. We'd now be taking 2% profits from this movement up, which is already good, already a nice return. But what we can do now is allow the trade to continue because we are still running 2% in profits as well, now that we're at 4R. And because we have that higher time frame narrative, we're going to be a bit more confident holding our trades for the longer term. So if we now hold this trade, we're now holding it through the night, into the next day, through London session, and then into the next day's New York session, we get a fill of that larger target, which should be 4.5 or 4.7% return on the other half of the trade, turning this initial 2.1 RR trade into a potential 6.7 RR or something like that in total. So we get 2% profit taken here and around 4.7 or so taken on the full fill of this move. And all you actually had to do here was not close the trade until tomorrow. You can close a bit, make sure you've got your day trading profits locked in, but because of the top-down move, we get to profit maximize and hold trades a little bit longer to let them get to those larger targets. Now, as I said, occasionally, not often, but sometimes, you'll be able to turn a day trade into something massively significant. If we take a look at the first initial target that we looked at in this market, the higher one up here, and we extend our targets up to this point for the second half of the position, we've now turned a very small profit potential trade of 2.1R into 22.5%. And obviously being a day trader, it's likely that you want to take at least half the profits before the day is over. So you've taken your 2%, that still leaves an opportunity to make 11.25% here on this continuation through simply by not clicking the close button. It's really that easy. When you get into the market and you've got a solid narrative, all you have to do is just not close the trade. If you leave the trade running like this one here, within just a matter of days or a week, you can get significantly larger profits from your positions. So this is where you benefit from using those day trading entries to get super refined stop losses, and then using that higher type of picture to actually nail huge targets. Small stop, large target, that's going to be some significant reward. And that would have turned this position into full potential trade of 13.5% or 13.25%, with that half taken here and half taken here. And let's take a look how long this trade took to play out. So this is running from the 14th to the 22nd of February, which means this trade was held for 1 week. It's not really a long amount of time to hold a trade that you can get this much profit out of. And now from this point, obviously, with the high time frame narrative in mind, we may have the idea that this is about as far as the market's going to get. So then we could go to the lower time frames from the supply to look for shorting opportunities to capitalize from the move back down. And that is how you can use top-down analysis to get more profit out of your day trades. If you do this, you will turn choppy ranges into very clear ranges to trade from. You've got that bigger picture narrative telling you the context. You need to understand where the opportunities might come in. 5-minute looks like a mess, 15-minute looks like a mess. But if you go to the daily, things make a lot more sense in terms of where you can target and where you can get in. And the profit maximization you can get from doing this allows you to catch some of these huge trades. That number one will be very nice for your account balance, and number two, you can brag about to your friends. So that's it for this video. If you want to become a profitable trader, you should watch this video next.